Moody's has downgraded the United States credit rating. The country's long-held AAA rating, the highest possible, has been cut to AA1, the second highest. AAA means a nation is considered virtually risk-free, a gold standard for credit. AA1 still means strong, but it signals slightly more risk. The reason? Soaring government debt and rising interest payments, both now significantly worse than in other top-rated economies. It's a sharp blow to President Donald Trump's narrative of economic strength, made worse by the same-day failure of his key spending bill in Congress, blocked by a group of Republican fiscal hawks. Moody's cited over a decade of unchecked debt growth, further worsened by the COVID-19 pandemic. The U.S., they said, has done little to fix it. Now, all three major rating agencies, S&P, Fitch, and Moody's, have downgraded the U.S. in recent years. In response, U.S. Treasury Secretary Scott Bessent downplayed the decision. Speaking on CNN, he called it a lagging indicator and pointed the finger at the Biden administration. He further added, and I quote, "We didn't get here in the past 100 days. It's the Biden administration and the spending we've seen over the past 4 years that we inherited, a 6.7% deficit to GDP, the highest ever outside of war or recession." Moody's did revise the outlook from negative to stable, citing America's vast economy, the resilience of its markets, and the global dominance of the U.S. dollar. But the signal is clear. America is no longer viewed as the gold standard of credit. The timing made it worse. Investors had just begun returning to riskier assets after a trade breakthrough between Washington and Beijing. But Moody's move was a harsh reminder. The debt problem isn't going away. Analysts say the downgrade could push Treasury yields higher, raising the government's cost of borrowing. And on Monday, that's exactly what happened. U.S. stock futures dropped sharply. Investors sold off U.S. Treasuries. The benchmark 10-year yield rose to 4.5%, while the 30-year yield crossed 5%. The U.S. dollar tumbled 0.9% against a basket of global currencies. And gold, the classic safe haven, jumped 1.4%. Bottom line, markets are nervous. America's debt is growing, and confidence, both in Washington and on Wall Street, is slipping.